What's up, guys? Real Trader Joe here. It is August 16th, 2024. The market taking a breather here, and our P&L, of course, going to be down on the day with Palo Alto coming out right out of the gate, down $5. But I'll go ahead and throw something interesting in the YouTube chat. Just before I started the broadcast, I was doing some research on VIX and volatility. I've mentioned it a few times before. We've had a lot of different volatility movement here in these last few weeks, but I saw something interesting on the VIX, and why selling the VIX usually doesn't work out from a risk-reward perspective that I thought I wanted to share with you guys. So let me go ahead and pull up the segment here. I'll put it in the YouTube chat if you want to take a look at it. Just throw that in there real quick. There we go. Yeah, go ahead and give that guy a gander if you're curious. So the TLDR of the segment is that selling the VIX is profitable most of the time, but when you're wrong, right? When the VIX spikes, you tend to get hurt pretty bad, especially if you do naked strangles. If you take a look at that Tasty Trade research segment, the max loss is like 6,000, right? So, I mean, let's just say we sold a strangle here. I mean, you're not gonna sell. I'm not gonna sell this. As a premium seller, I'm not going to sell the 14 strike puts here because they're worth pennies. They're worth 47 cents for that risk, when the VIX historically is really less than 15 a lot of the time. But, if you sold a strangle, if you just said, well, I'll take the bet. I will take the bet that the VIX is going to remain under 20. Your win rate's going to be good. Your win rate's going to be 70 or 80%, but obviously... let's go to the daily chart on the VIX. I was doing some 15-minute stuff earlier, but obviously with the massive VIX spike that we saw here, when you're wrong, you're gonna get smashed. I mean, the Tasty Trade research segment said that you're looking at like a $6,000 loser, but the real danger, of course, isn't that the position won't eventually recover, because the VIX will eventually drop from that level. It's that you'll get margin called, and that open loss is usually about $6,000 per one lot. So, let's say you decided to get frisky here and you sold 1, 2, 3, 4, you sold 5 of these. I mean, look at that. Like, yeah, even the platform's like, nah, man, you're not doing that. But let's say, I have about a $75,000 account, so it's in theory still within position sizing guidelines for me to sell this, for me to sell about 6,000. I mean, maybe you could bump that down. Okay, $3,000. That's about 5%, roughly. So this is within sizing guidelines, but when you get a VIX spike, you're going to be looking at a huge open loser in notional value. Your dollars that you're actually losing, in theory, are going to be about $6,000 one lot. And like I said, I linked the research segment there if you want to take a look at that. But that's the long and short of why I personally don't sell VIX. It's that research segment sort of quantitatively affirmed what I've intuited to be true, which is that the risk-reward of the VIX is not that great. You'll win a lot of the time. A lot of the time, you're going to make out okay, but when you don't, you're going to get crushed hard. And, yeah, I mean, I think, if you're gonna sell anything, during the VIX move, obviously you get increased win rate, increased P&L, all the good stuff. Obviously, if you were fortunate enough to catch that 65 right at the high and sell, a VIX of 100, then maybe you could make out okay. But, the vast majority of the time, you're not going to be able to predict that movement. So if you're selling calls at the 20, 25, 30 strike, and you get a spike up to 60 or 70, yeah, that's not good. You're obligating yourself to sell shares of VIX you don't have, to have them called away to you, but you have to buy them back at a really high price. And depending on your account size, you can get margin called. I mean, for example, let's just say that I sold, let's go into the 32-day VIX. Let's say I sold 3 of these. Let's say I sold 3 18 strike calls at $135 each. I mean, right there, that's $405. And $32, if the VIX isn't higher than 18, I'm going to win. And the majority of the time, the VIX isn't going to go any higher than, let's say, 20. Let's say I want to be really safe and go to 21. Yeah, I mean, unless the market, goes crazy, that's 300. It seems like 306 free bucks, right? Seems like a 90% win rate. Like, you're going to be fine. But, with the black swan events, when the VIX does spike, you get absolutely smashed. So let's just say, for argument's sake, if I sold 3 of these 20 strike puts, that's $6,000 in notional buying power requirement per 1 lot, and that's $18,000. That's an $18,000 position. That's similar to the levels that I was dealing with when I sold like SMCI calls and stuff like that, which didn't work out well for me. Spoiler alert, because of the same reason. I got margin called and couldn't hold the position. I was going to be right in the end, but I mean, being right doesn't matter if you get margin called and have to sell out of other stuff, and it's just an ugly business. So that's an interesting research segment on volatility there, if you want to take a look at that. In the meantime, let's go ahead and get into the market dynamics. We got Bitcoin up, not good for our Coinbase position, but that roll here to the 150 strike that we did yesterday, doing well to neutralize the position. And like I said, we are going to lose more and more theta as time progresses, but we're buying ourselves as much time as possible for Coinbase to turn around. Interestingly, I'm long the rest of the portfolio, so maybe going bearish on Bitcoin wasn't that great of an idea, because Bitcoin is a good hedge. I was pretty much playing the technicals there and probably playing them wrong, but I still think we've done a stellar job of evacuating ourselves from this cost basis here. I mean, we're really putting the air brakes on with these short puts here. So happy to give Coinbase more time. We still have plenty of time in the cycle. 28 days is more than enough time for things to happen. I mean, look at all this price action in the last 28 days or so. Sorry, let's scroll over here. Yeah, I mean, July to now, all the way from 265 down to 201, so very possible to go from 201 to 160. Wouldn't doubt it, especially with Coinbase. The Qs are down, which is nice to see. I know we are net short Q, so QQQ, happy to see that go down a little bit. That's good for our strangle. Gives our short call here at 479 some breathing room. Short approximately 34 shares, so that position is happy. The rest of our portfolio is either neutral or struggling a little bit. But overall, VIX up and markets down slightly today, to be expected with the rally we've had. I mean, here we go. Another platform crash, I think. Yeah, what is going on with this? I'm really not sure what the deal is. I'm not running out of memory. And I think it's probably just the way I'm clicking around. Maybe I'm clicking something in sequence. But let's get out of there, and we'll just reopen it real quick, and then go back into OBS. I am going to have to maybe put a monitor on. My platform will crash, at least once a week. And it's not a hardware problem. I mean, my PC's got 64 gigs of memory, and in just about every way is pretty equipped to deal with all that stuff. So there we go. We're back up. But yeah, I mean, if the markets rally, it's not going to be a big deal. But look at Palo Alto. So this is why I said we're going to hold on to this 350 call, because it is on the ratio spread, right? We have more than 100 deltas, so we're going to lose pretty much what you see here on the net change and then some. If you think you have 100 shares, you're down 434, you're going to lose $534. The options are going to be slightly different, but we have more than 100 shares of exposure. So just as a rough calculation, you can see here, whatever the stock does, we're going to gain and lose on this ratio spread. The short call, though, changes things up because we're short here. So this is kind of our total exposure, this delta up here. If you're new to options, delta is your total exposure. So 113 shares of exposure with this part of the option spread, and then we have minus 40 shares with this part. So we're long 72 shares, and the short call. All of this value is going to come out at expiration, or it's going to be worth whatever the intrinsic value is. Remember, we're not at 350. We're obligated. There we go. So yeah, I mean, you can see here, Palo Alto at 208, $268 on the short call. So just to recap, more than 100 shares of exposure on our synthetic stock, which is this portion of the spread. Then we've got the short call at 350 that is hedging against that, and that 350 strike call has 7 days of uncertainty left. So at 0 days of uncertainty, at expiration, that 350 call is either going to be worth something to somebody who bought it, or it's going to be worth nothing. If it's worth something, then it has to be above 350, because remember, we're selling our shares to them at 350, and if they said, hey, I want you to sell us your shares at 350, I'd say, great, the market wants them at 336. I'll happily sell my shares to you at, $14 above market price. So yeah, Palo Alto really taking it on the chin here today. Down $7, and geez. Yeah, I'm really happy we kept this as grim as it's looking. We're gonna be able to roll this out for boatloads of money here in the next couple days. We're gonna hold it into the weekend, just because we are getting, look at this theta, 107 theta a day. So this option's gonna lose 10% of its value and more heading into earnings. So in 3 days, this should be worth about 300 less. And we have until the close on August 19th to make a decision. So we'll probably do that Monday morning. We'll decide what we want to do with this guy. I may hold on to him, or I may just roll him out into the next cycle. I really don't see a reason to decide today when we have 3 more days of theta decay. I mean, look at here. The expected move is only up to 365, so we could buy this guy back and sell. Let's say we sell the 35-day and we want to go to 365. We can do that now for a net credit. We can obligate ourselves to sell $10 higher, which is going to be good for us, allows us more room to run. Should Palo Alto go to the upside, we can receive a credit. We're going to lose some theta, and we're going to essentially gain some upward exposure. But again, that's today, and we have 3 more days on that guy before we have to decide. So it's very possible that we could look at rolling this August 23rd contract at 350 to the 360 strike for more than 67 cents. I mean, we might even get $2 or $3 for doing that, which, again, is going to be just fine. Every time we roll, we're de-risking, and we only have about 5 more months on this synthetic stock here. So any kind of downward protection that we can scrape together is going to be helpful. It's going to improve the cost basis, and it really gives us some control and some flexibility over our shares. But market's really beginning to sell off some steam here, and Coinbase, unfortunately, is Bitcoin just going the other direction. So kind of feeling the love a little bit today, but we've had a lot of days recently where things have been really good. So that's cool, though. That's one of the reasons we're overall short the Qs, is because we thought that downtrend might continue, even if it doesn't. This is one of the reasons that selling options is so profitable, because we can just profit in so many different ways. We have this this positive theta working for us here. $91 today, and we're only down, a couple bucks on this contract. Being down 194 with 35 days to go, no problem. Totally comfortable holding this. And I'll just, show you guys the profit graph here. So we're down, in theory, 270 bucks. Down a little less than that, actually, but the platform takes into account various things. So if we just fast forward this, right? If we just fast forward to 21 days to go at the end of the month, then we'll be profitable 52 bucks. And should QQQ continue to fall, anywhere in this range is going to be money. We're going to get $500 there. So still plenty of room. We've got all the way till 479 before we even have to be remotely concerned about this. And even then, I mean, we can start, if we need to, we can start rolling up the untested side, sacrificing some profit in the downside direction. Look at that. I mean, we could even right now roll to this 450 strike for an additional $2 to the upside. And if you want to get really fancy, we can use that $2 to buy this back and sell it at a lower price. So to give ourselves even more upside room, we collect less credit, and we don't give ourselves the same width that the trade has right now. You can see 450 to 484 is about $34. The original trade is from 420 to 479, so call that 480, 60 bucks. So moral of the story is, just because the position looks ugly doesn't mean that it's going to end up that way. And the reverse is true, right? Just because positions look good doesn't mean that they're going to end up good. So with short options, because you carry so much risk, it's imperative that you're able to control your risk effectively. And right now, like I said, overall with the portfolio, we're not doing that from a capital allocation perspective. We're still too over allocated. So really, with a lot of these trades, it's going to be working to get these long running losers back to even or close to it. So ARM looks ugly, but like I said, we've got all that short theta, and we've turned this into a synthetic strangle. So a downturn in the markets is not going to be bad for us overall. But I mean, look at this. So in theory, down 189. We're down more than that on the order chain, but 21 days to go. Look at that. Profitable by 179. So a $300 swing, and we can just keep doing this, right? If at 35 days to go we run into some problems, we kick this out into October, no problem. So I'm still pretty happy with the way the portfolio has gone today. Dell, we're pretty much neutral on, so if Dell decides to stay where it is, I'm cool with that. We don't need the market to be rallying like it has been, because we exhausted all our bullish deltas. We used up all our upside bias when the market rallied. That's the interesting thing about options, unlike stocks, is that when you have an options portfolio, your risk exposure is constantly changing. And the reason that's important is because when the market gets longer, you typically get shorter. If you're short premium, that is, and and you don't have just short puts in the portfolio, right? I mean, if you're thinking about just the way a portfolio is allocated, if you were long up here, if you were long right in the middle of July, you're still in some pain. If you've had a long portfolio the whole year, you're probably happy. But if you switched your bias here, like I kind of did, you're not really in the happiest position. So yeah, now we just have to wait and see. But like I said, no new trades today, just kind of keeping stock of everything. Palo Alto down 500s. Wow. Yeah, I mean, this option's going to decay fast. So we sold it for $244. It's worth $10.82. It was worth like $13 yesterday. And going over the weekend, Monday morning, I would expect this to be worth less than that, probably around $8 or $9 going into Monday. So it's very possible we can roll this out and feel really good about it. I'm certainly not just going to close this out for a loss. Not when we're out of the money. I'll roll it or whatever, but we will decide that on Monday, because I don't think Palo Alto's getting to 350 by Monday. And if it does, that's cool. You know what? I mean, for the amount of capital I have tied up here, I'll be more than happy to give this up and move on and take my, 4 or 5%, whatever it is, on just one stock. So, that's capital that we can repurpose elsewhere. There's always blessings. And the blessing here, should Palo Alto hit 350, is that we would be able to take that capital and repurpose it. Other than that, Coinbase really having a rally, which, again, remember yesterday how I said we trimmed our downside exposure? That was looking to be a prudent move, because now this 150 strike short put with the longer dated expiration is soaking up all that upside move and really shielding us from the worst of this. This diagonal spread, obviously not in a good way, but because this 21 is going to go to 0 and this 5 is going to go to 0, so 21 minus 5 is about 17, give or take, and that's what we're going to end up with. We still have about $500 more we can lose, but this 5 is also going to go to 0, so it just won't go to 0 as fast. So 21 minus 10 is about 11, and I mean, our cost basis on this trade, I think, is actually maybe even better than that. So yeah, we paid 12. Well, so you can actually see here, we put the diagonal on for about $17, and our roll here with this 165 put took off about 5, less than 5, but we'll just call it 5 for easy math. So that's about 12.39, but about 12. And then we're selling an additional 5.42. So 12 minus, we'll just call it 5.5. You know, those are generous numbers, but we're going to lose anywhere between $6 to $8 on this trade, which is not bad at all. I mean, that's like 1%. And for how viciously Coinbase has moved against us in the interim, I mean, we got short down here, you know, thinking that this might continue. So I'm totally good with that loss. I mean, this is loss mitigation 101. You know, we have the embedded diagonal. We don't want coin to go too far down. It's a tough position because if coin just tanks, we lose there too. But yeah, this is just about keeping the ship steady, and I mean it's not steady. We're sinking. Let's call a spade a spade. This is a ship that this is a ship that we are thinking about abandoning. And by thinking about abandoning, I mean we're gonna hold it until all the crew are gone and she goes under. But you know, in the meantime, we'll just plug up the holes with some copier paper and call it a day. So, other than that, nothing else really going on. We got all these positions here. You can see the short theta doing some work for us here on positions that have really no directional impact. VST and, you know, Tesla being two of those that are under 20 delta. The VIX going up today is always, you know, never good for volatility, but other than that, I'm pretty much good to go. And you can see, again, just this Palo Alto position down about $7, and we're down actually more than that on the long leg of our ratio spread. But 525 overall, and half of that loss being absorbed by that short call here, so that's why we kept it. Other than that, guys, that has been our little segment for today. I don't have anything else, but hopefully you found that VIX info helpful. And like I said, I did go ahead and put that in chat. If you guys do want to check that out, I highly recommend it, especially if you guys are selling some premium. That's going to be helpful. So, happy to deliver all this to you, and I will see you guys Monday morning. Peace.